All right, I think we are live. Hey everyone, and welcome to another edition of our weekly show, the Dividend Power Hour. How is everyone doing out there? I already see some comments going on there in the chat room. Again, my name is Mark Rusin. I'm a CPA. We like to do these every week, and it just gives me a chance to talk stocks with you guys and also get some questions to be able to interact directly with the subscribers and the folks watching here on the Dividend Power Hour. We got a great show today to go through. We got some earnings that have hit the tape the past few days and the end of last week after our show. And we're also going to go through my top 5 positions. And I'd like to see what some of your guys' top positions are out there as well. So let's dive right into the show. But off the top of it, let me know, did you guys buy anything this week so far? Let me know in the comment section which stocks you have bought so far this week with the stock market. There's nothing really. I've been doing some options trading just with where the technology sector has been. And doing some great ones there to try. I always try to generate around $2,000 in income from option premium. I have a full Discord that I show all my option trades there. But let me know. Did you guys buy anything there in the chat room? Let me know, and then we will get started. Let me load the slides while you guys are commenting on what you bought this week. All right, again, so this is the Dividend Power. This is our weekly look at the economy. We like to go through, what has been going on in the stock market, in the economy as a whole. We have a return of the Dow, actually. It's been all about the technology sector of late, but now, more recently, it's the return of the Dow. We have now another positive day today, making it 9 straight days of gains for the Dow Jones. And let me share my screen here, and you guys can see exactly over here at and we can look here at the Dow Jones, which was up again during this session here. So if we go to the Dow Jones and let's look at what we've been doing, it's really been a laggard so far especially when you compare it to the S&P 500. So over the past 5 days, the Dow Jones is up 2.4%. Over the past month, we're at 3.77%. 3 months, 4.2, and then year to date, we are in the red. So just going back just a few months, that we were really struggling there, teetering between red and green with the Dow Jones, as compared to the NASDAQ, which has just been a high flyer. So look at those numbers right there. Now let's turn over to the NASDAQ, and you guys can see just how different those two have been. So 5 days, it's really been stagnant for the NASDAQ. Over the past month, they're still in the green. But when you look at that year-to-date figure, up nearly 35%. That is just incredible growth, what we've seen so far. So really interesting there to see 9 straight days of gains for the Dow Jones. So let me run over here to the comments before I keep going to see what you guys have bought this week. Paladin made it to the live chat, watching in the UK. Great to have you. Amadou bought some Realty Income and some EPD. Drew is in the house here. Hello, the dividend investor, another CPA friend of mine there. Danny, just started dividend investing myself. Wow, look at these names. You just started off, and this is some solid names here. You got yourself some Vici, which is my #1 REIT that I own. You got yourself some PEP, PepsiCo there. So it's great, one of the largest beverage and snack businesses globally. And then you have some RTX. So you're already diversified. You have REIT so far, more of a consumer staple, and then you have a defense contractor. And then we have J&J, which is going to give you healthcare. Then we're going to go to Realty Income, which is a very popular, the monthly dividend company. PLD, hopefully you just bought that one in the last day or so. That one released earnings this week. And investors weren't a big fan of that one. They were really concerned about the lack of rent growth. But management has come out and said, hey, regardless of if occupancy goes down, we are focusing on continuing to try to increase those rents moving forward. So that was interesting. I like them kind of just standing there because we have to remember that when it comes to REITs, these are long-term agreements that they're entering into. So if they don't stand their ground right now, even though the market could be a little, the footing isn't great for tenants to come in, they understand that e-commerce is going to continue to grow and that the agreements that they enter in today could be in place for 8 to 10 years. So it's very important to get your rents in because you add rent escalators each and every year. So some great stocks there for Danny between Vici, PepsiCo, RTX, J&J, PLD, and TXRH. Awesome there. All right, let's see. We bought some MasterCard, some Target, Procter & Gamble, ARCC, and some AbbVie. Love it there. Some good investments. Very good mix of investments as well. And something, we don't see that all that often, no real technology, there. So big tech stocks. So that's good. Trying to go value hunting. Replace EPD with Magellan. Well, Lex is in the house. You haven't missed much, Lex. You are there. You are all good. All right, the dividend investor. I hold no ETFs. My top holdings are Microsoft, Apple, TD, BN, and JP Morgan. Very closely tied to a bunch of my other holdings in terms of percentage, but those are the top 5. And I'd have to say the dividend investors portfolio is probably doing quite well with those 2 top leaders there between Microsoft and Apple. JP Morgan released. We will talk about their earnings here in a second as well. Let's see what else we got. William is Mark. I'm slowly building on SCHD, Devo, O, and JEPI. So awesome there. You got a good list of different ETFs. SCHD has really been underperforming, but of late it's kind of turned the corner per se a little bit, especially with the move in Johnson & Johnson today. So that was good for that one, because we're starting to see a little bit more of the broadening in this rally. It's been really one-sided between the top sectors being technology and consumer services, or communication services, with Meta and Google in that one. And it's really been your Amazons of the world, Nvidia, Tesla. Those have started to take a little bit of a break, and we're starting to see the others start to catch up. A lot of what we've talked about on this channel, especially during our Dividend Power Hour, how things look a little frothy up top in terms of particular sectors, but that doesn't mean other sectors can't move. Total Returns bought some Vici. Top holdings is Johnson & Johnson. Smashed it today. They certainly did, and we're going to talk about that one. That one was very exciting, and for me, being a top position for me, very much overdue. Lex with some PNC. I tried to get in some options with PNC the other day, Lex, and I wasn't able to there. Robbie, how are you doing? Thanks for joining the Dividend Power Hour today. All right, what else we got? Hello, guys. I see you guys in the comments section. Charles with LEG is on sale. Mark, probably a good idea to talk about B of A when discussing JP Morgan as well. Rising tide lifted all the ships. Just a thought. Absolutely. We are going to go over some bank earnings today as well. Danny, thank you for that comment there. Let's see what Jim bought. Jim bought some ET, some CAG, and EPD this week. All right. And then Mike with a quick comment here. MPW. So he's taking some risks there with Medical Properties Trust. EPD, BXMT, some Maine. So he's getting himself some monthly income there. CCI, another, that one's a REIT. CCI and American Tower have just been crushed over the past year. Some Foot Locker, some SVOL, UTG, RNP, and Vici. Mike, you were busy the first 4 trading days of the week so far. So that is awesome. So let's keep rolling here and take a closer look at where we are with the economy. So return of the Dow, 9 straight days of gains. Year to date is up 6.3%. Valuation still estimating, we're saying we've upped it last week to $230 for the full year here in 2023. Puts us around 19.6 times. So we haven't moved all that much from the prior week, but still well above the average valuation, which is usually around 15, 16 times. So, but tech, like I had already mentioned, is starting to take a little bit of a break. So, and it's more recently, though. We saw the XLK reach a new record high just this week. So let me go back over to my screen here, add this to the screen, and let's take a look at XLK. So this is XLK, which is the Technology Selects Sector Spider. So this is just focusing. If I go to holdings here, this is Seeking Alpha. For those of you wondering what is on my screen, you could see technology is the #1 and the only sector for XLK. So this is just a technology focused. You can see the top 10 holdings include Microsoft and Apple, which account for nearly 45%. So if you really like both of those and you're like, oh man, I don't have a lot of money. Do I want to split it, or do I want to just buy Apple or just buy Microsoft? Maybe just buy XLK, because that's going to give you 45% and you get the best of both worlds. You also get Nvidia, Broadcom, Adobe, Salesforce, Cisco, Accenture, AMD, and Oracle rounding out the top 10. And those top 10 positions are very top heavy, as it accounts for nearly 70% of that entire ETF. So this is a great way if you're looking for technology exposure, which hopefully none of us are looking for technology exposure right this instant, I should say, just because of what we're talking about here. We just recently hit an all-time high for XLK. This is even going back to the 2020 boom that we saw. That's what we just blew through that top. So we did kind of take a little bit of a breather though today. We were down 2%, but that was primarily focused on a couple of positions that that we'll talk about here with earnings. But overall, a top. I mean, it looks like a top, and it looks like we're bouncing off that resistance level there for XLK. So still not looking to add any technology exposure to my portfolio right this instant here. But again, it was down 2% today. That's just one day. We're not going to read too much into it. There was a lot of other things with Tesla was down big today. Netflix was down big today after their earnings, and I think it kind of just brought that whole sector down with it. So moving on to employment now, or unemployment, we should say. Jobless claims actually dropped 9,000 to 228,000. That's a drop of 9,000 from the prior week. And then the other thing to look at is continuing claims. So these are folks that have been on that unemployment list. That increased to 33,000 to 1.7 million that continue to be on that unemployment list. Housing, the average 30-year mortgage sits at around 7.15, very high. And this is, continues to be an issue for the sector in terms of inventory being very low. That goes back just to our normal supply and demand metrics, where there's just not a ton of supply out there, and that's been a great thing for the home builders. They are back to this situation where they can't build homes fast enough. Prices are still very high, so you have high prices, low inventory, and even high mortgage rates. So it's really rough. It's been the hardest time. I read something the other day that it's been the hardest time for new home buyers. So if this is your first time buying a home, it's a really tough environment to get into, where inventory is low, prices are high, but not only are prices high, but that 30-year mortgage is high as well. So unless you're out there paying cash, it's a rough market for first-time home buyers. Now, on the flip side, for those of you that own a home and you're likely sitting on a mortgage rate that may be below 4%, because I think it's around 65% or so of homeowners right now have a 30-year mortgage or a mortgage rate below 4%. So there's really no incentive, unless you're forced to or have to, a job relocation, who knows what it is, have to be closer to family. There's a ton of reasons, I'm sure, but if there's not a need to move right now, you're most likely not going to move. So that's the housing sector in a nutshell right now. And then earnings. So we are firmly into Q2 earnings now. The big banks got us kick-started last week, and let's roll right into those. I know the Dividend Investor CPA was wanting me to mention bank earnings. That was right on cue right there. So let's take a look at some of these big banks. So JP Morgan, Wells Fargo, they released earnings on Friday. So we do our show on Thursday, so we didn't get to see these. This will be the first time we get to see those and talk about them here on the Dividend Power Hour. So JP Morgan Chase, stock ticker JPM, had a blowout quarter. EPS came in at $4.37. Usually when you're comparing to analyst estimates, they'll beat by, say, 5 cents, 10 cents. No, they beat by 61 cents. So a solid beat there on the bottom line. And on the top line, this is where, especially when you have revenues in the billions, you'll see some beats by, maybe 1 billion is going to be a lot, but 600 million or something. No, they beat by $2.5 billion. So a big beat on revenue there at 41.3 billion for JP Morgan. Assets are still at 3.9 trillion, making it the largest bank there in terms of assets. And then NII, that's going to be your net interest income. And I've talked about that on the channel before when I've been focusing on bank stocks in a particular video. But if you haven't seen any of those, NII, net interest income, you could look at net interest margin as well. And it's really going to be the difference, because banks, they loan money out. So let's say you want to buy a house and you could do your loan, or a small business loan or something like that. They're going to earn an income from that loan. So say it's 7.3% we'll use. Well, then they turn around. They also have to pay out interest income to someone like yourself that may have a savings account, a high yield savings account, say, with JP Morgan. But the difference between those is going to be thought of as your net interest income. So that's the money as interest rates continue to climb. That allows JP Morgans of the world, Wells Fargo's of the world, Bank of America to charge more for loans. But at the same time, the savings rates aren't climbing, as you're probably well aware, as fast as the loans that they're charging. So that gap is widening. And when we look here, we can see that the net interest income was up 41% year over year for JP Morgan. So that was a big beneficiary for JP Morgan. So now turning over to Wells Fargo. Wells Fargo reported EPS of $1.25. They beat by 9 cents. So that's a solid beat in and itself. It's not a 61-cent beat. And it's also a much smaller EPS there as well. So we have to take that into account. But in terms of revenue came in at $20.53 billion. So about half of what JP Morgan did, but they beat by $410 million. So that was a solid beat there for Wells Fargo as well, beating on both the top and the bottom line. The thing I really wanted to focus on was number one, deposits. So going back to JP Morgan, they actually did see deposits that came down a little bit, with all the mini banking crisis that we've had. Deposits came down a little bit. And usually when they see deposits coming down, they want to incentivize customers to come back to put their money back into the bank. That's when you usually see the savings rates come up. They'll say, hey, come back and you'll get 5% on your savings for the next, 2-3 months or something like that. They didn't really move the savings rates all that much, which is one of the reasons that attributed to the higher NII for them. So going back here now to Wells Fargo, the thing that you want to watch out with banks is looking at their credit provision. So going back about 5 years, the credit provision out there was quite low. The consumer was doing quite well. The consumer still is doing quite well, but we're starting to see a bit of a slowdown. And what they're doing is saying, okay, we have these credit card balances that are out there. We have these loans that are out there. Not all of them are going to pay off. People, consumers, businesses, owners of real estate are going to have trouble to where they're not going to be able to pay back their loan. As such, a company that's giving out loans, like a bank, needs to add provisions for that. They're saying, if we don't get paid back on that loan, we need to have money set aside that's going to, it's not going to take over everything, but it's going to be able to shield us from some of those losses per se. So that's what really a way to think of the credit provisions in a way. So as they start to look out and see consumers start to struggle, see some tenants or folks that own real estate loans start to struggle, because there's a real issue going around. It's been a hot topic around commercial real estate. And, office buildings are just vacant. They have, 50% vacancies out there. If landlords are getting paid only 50% of the rent, they're having trouble continuing to pay their debt on that building. So the banks are starting to look ahead, and this is a good way to foreshadow what's ahead for the economy. This is just one way to kind of do that. So we're continuing to see those credit provisions continue to climb. So for Wells Fargo, we saw increased credit provisions of nearly $1 billion, so $900 million. And that is they now have a balance of $1.7 billion. So by doing these, by increasing these credit provisions, it's a direct hit on their P&L, or their income statement, I should say. And a lot of it they made in their management commentary. They said a lot of it was due to commercial real estate and higher credit card balances. So they're starting to see cracks in the consumer a little bit, and definitely cracks in the commercial real estate sector, which Wells Fargo themselves does have high exposure to. So that was the one I was concerned about in terms of commercial real estate. So let me look over in the comment section here to see what any questions that you guys have here. So Paul became a YouTube vet. Thank you, Paul. I appreciate the support there. Great to have you on the show here today. The dividend investor in Jamie we trust. He's been, one of the best, if not the best, leader there in terms of the banking sector. A lot of folks look to him for his wisdom. I think CEO Brian Moynihan from Bank of America is hot on his tail. Obviously, you guys know, for those of you that have watched the show a lot, that I'm a big fan of his and Bank of America themselves. So Sean bought some NVIDIA, Microsoft, TSLY, and more Tesla. So hopefully that was a buy on the drop there. Paul he bought CALM, TSN, XRX, Vici, which we touched on, some Cigna, or CI, I should say, United Health. I'd be curious, Paul, if that United Health was before or after earnings. Regardless, I still like it. But it's a position that I bought. When did we buy that? Probably about a month and a half ago on their original big drop. So we've been making some good money on that one, especially with the run that we saw in the past 5 days. So let me know, did you buy that one before or after, and then you added some Humira? All right. William said, Mark, if already hold some O, should I consider adding WPC or just focus on O? Well, that one's a little bit more difficult to answer, because number one, I don't know what your entire portfolio is. So if you just held I'd obviously want to say let's diversify. WPC looks very cheap right now. It's going to be a different animal than Realty Income. So they're obviously in different sectors. WPC, one reason I like it is because of that industrial and warehouse exposure, which it may not gain a ton of, could see some bumpiness, which WPC already has, just like we saw with PLD. But if you're a long-term believer, a long-term investor, but specifically a long-term believer that e-commerce is going to continue to grow. E-commerce is still in that 15 to 20% range in terms of total sales, but that's growing at such a fast clip. So even though we go into a small little recession, I think e-commerce is still going to do quite well. A lot of folks are going to say, hey, let's just stay home. But, it's so easy to go on someone like Amazon, which controls 35% of the entire market, and just buy something that's going to show up the next day or 2 days later, wherever, depending on where you live and if you have Prime. But, both of those, regardless, are both REITs that I like. Both REITs I like at today's valuation as well. So hopefully that helps answer that a little bit. Your June portfolio shows 1/3 in ETFs and 1/5 in REITs. Is that your goal? So great question, Lex. So for me, I always want to have REITs around a 15 to 20%. That's in terms of my strategy. My goal is around that 15 to 20% exposure to REITs. Again, now this is a long-term portfolio, so that's why that piece of the portfolio has been underperforming. But just seeing a lot of these REITs, knowing where we're at in the not just the economic cycle, but knowing where we're at in terms of interest rates, tells me that I want to start building a position. WPC is one of those that is just they're high quality blue chip type REITs at low valuations. So I'm not worried about outperforming the S&P 500 today or tomorrow. I'm worried about building a long-term stable portfolio for the long term. So, REITs has allowed me, they've shown an ability to outperform many sectors over past decades, not just, one, but decade after decade after decade. REITs is always going to be, not always, obviously the last year or so, they've been in the dumpster, but they've proven themselves to be great performers there. So that's kind of my goal. Still here. Not sure what happened there, folks. Sorry about that. But that's kind of what I was saying. That's what I'm focusing on in terms of looking at REITs, and just trying to. Oh, can you still see me, Jay? Let me know if you guys can still. I saw someone in there saying they couldn't see me, but AMT. All right, so let's keep rolling here with the slide deck. So now we're going to go. We looked at banks, the first two banks. Now let's take a look closer to Bank of America, which is a fan favorite of mine personally. Bank of America came in at EPS of 88 cents. They beat by 5 cents. It's a normal beat there, obviously lower EPS. Their revenues came in at 25.2 billion. That beat by 260 billion compared to, and when I say beat by, that's compared to what the average analyst estimates there were. So a beat again. When we look at all of the banks that we've looked at so far. So JP Morgan, beat. Wells Fargo, beat on top and bottom line. Now we look at Bank of America, beat. So the banks are performing quite well. NII was up 14% year over year. And then the other thing I want to look at is they increased their credit provision by 602 million, bringing the total up to 1.1 billion in credit provision there. So they took a big hit on the P&L. But let's head over to. Let me share my screen here so we can see how some of these bank stocks have been doing over the past week. Once you see a lot of movement from these shares when they're reporting earnings. So let's take a look here. This is our XLK. So let's go to JP Morgan first. Take a look at JP Morgan. The JP Morgan over the past 5 days up 3%. So they reported earnings on Friday. And since then, they've been up 3%. A lot of the banks have pulled JP Morgan forward there. Let's take a look at what Wells Fargo's done. So Wells Fargo over the past 5 days, up 7%. So they had you could see it even when we go to the year-to-date one, the big swing. You saw a big drop here. But since then, really since that mini banking crisis, I like to call it, we've seen a good move here in Wells Fargo. And then lastly, in terms of banks, My favorite, Bank of America. And as we can see here, Bank of America up 8.1%. So this is a stock that we've continued to harp on and continue to talk about here on the Dividend Power Hour, saying that they're trading at 7 times, 8 times earnings. Stop looking so much at short term, look at long term. If you're following this channel, then you know by now I am a long term investor and I'm looking for great valuations right now. That is a great valuation. That is a well-run bank with a top management team. And when you're getting 7 or 8 times in the second largest bank in the entire US here, that's one I want to take advantage of. And that's exactly what I've been doing. So it's nice to start seeing some of these start to pay dividends, actually, no pun intended. All right. So let's look at some of the questions you guys got here. I'll scroll back up here. Paul added some WPC today. We were just talking about WPC, and he got into UNH before earnings. I think the health insurance stocks are undervalued. I would totally agree with that one. That's exactly why we added that one as well. And yes, it's a great addition here from the Dividend Investor. Those results were bolstered by the First Republic acquisition. The JPM did get a nice sizable gain that was added on to the P&L due to that First Republic takeover there. So that was a great add there. Thank you for that one. Danny started his dividend investing journey 7 to 18 on 7/18 this past week. Technically, my cost basis is lower than price as of right now on all of my stocks. Well, that is a good. When your cost basis is lower, that is a good problem to have there, Danny. Awesome. Yes, thank you. There you go. Kath is in the house. Awesome to have you, Kath. Hi, Mark. What are your thoughts on ARE? So we've been talking about REITs, getting a lot of REIT questions today. I love it because I love talking about this sector as a whole. So ARE is really been mixed in. We've talked about it a lot before. They've been mixed in as a office REIT. And, if you've watched any of my prior videos, you know how they differentiate themselves. They're more biotech focused, where a lot of folks that come in and have to do studies. There's a lot of in-house type of camaraderie and business that goes on. It's not like your typical office building where it's like, hey, Joe Schmo goes into his office, he sits there for 8 hours, he checks out and leaves. That's the typical office is really where you're seeing the 50% drop down in occupancy and where the true struggles are. But because they're considered an office REIT, they've kind of been pushed down as well. There's been a short report out on Alexandria that I totally don't agree with. I think I did a video covering that one. So let's take a look and see where our ARE is today. So I will type in ARE. Let me bring up that screen so that you guys can see what I'm looking at. There we go. So as you can see, ARE, really when we started hearing about more of these commercial real estate struggles has been right here when we're looking in February. That's when the ARE decline really started for them. So year to date, the stock is down 15%, trading at a very low valuation. You're at 13 times forward here. They're bringing an FFO of 894, and we're trading very close to our 52-week low. But with ARE right now, if you're a patient investor looking to take advantage of long-term positions, again, it's not something that, REITs aren't something that's going to take off and turn around in 15% within a month or something. It takes time, but you're also going to get a nice yield. So you're going to be compensated for that. You want to jump in now, you're going to be compensated with a 4.2% dividend yield. Now let's look at their growth hasn't been all that crazy. So it's only about 6.2% 5-year dividend growth rate for Alexandria there. But it's a position that I own, and I think it's just underappreciated, and a lot of folks don't understand how they differentiate themselves from different REITs. So once it's similar with WPC. They used to have a big office exposure. Folks are starting to learn more about their portfolio as a whole to be an industrial warehouse, which has much higher multiples. They're trading at a multiple that's below a net lease retail REIT, even with the likes of Realty Income. That should be the floor for someone like WPC. So I think there's a lot of expansion, FFO expansion that's able to get there, which is going to make up a lot of your gains. And again, at the same time, you're going to get a decent yield with them as well. So again, we saw Paul added WPC there. Sean bought after the drop. My bank stocks are long-term, JP Morgan and Bank of America on the U.S. side and RBC and TD on the Canadian side. I feel that U.S. investors should look at Canadian banks, average annual return of 12%. Totally agree there. There's been some great, especially, not just more recently or on a go-forward basis, some of those top, those top 5 banks over there on the Canadian side have been great long-term performers, and you're going to get some solid deals. So definitely, if you're trying to diversify your portfolio in a way, not just within the diversify it from sector basis, but just in the financial sector, don't just look at US ones, also look at a few of those Canadian ones as well. The J bought some AMT. Paul said, what do you think of self-storage REITs? Just bought NSA. So self-storage is something that, especially here in the US, Americans just don't get rid of stuff. Well, we don't have the bleeper button here on StreamYard, but they have trouble getting rid of stuff. So whether you're downsizing, whether there's large things you want to have and you don't want to keep them in the house, don't want to keep them in the garage. Maybe you want to build another room, or I've seen some neighbors that say, hey, I want to have a man cave in my garage. Well, there's a lot of stuff you got to get out of your garage, but most likely you don't want to get rid of that stuff. So what do? You go get a self-storage unit. Then you start paying the self-storage unit. You're paying the small fee, $50, $100, depending on the size you want. And then it's just kind of an automatic thing. Like, we need that storage. Where are we going to put the stuff? Who knows? So we keep that for a long duration of time. It's a proven sector that a lot of private investors go into. I really like the big 3 when it comes to self-storage. I own CubeSmart, which I really like their technology advancements that they've done there. You really don't even have to interact with anyone to rent a CubeSmart self-storage unit. Public Storage is obviously the largest. Those are the main 2, the 2 I own and the 2 I like the best. You can go, there's others like Extra Space. I don't see it. Let's see what Extra Space has been doing. We go to EXR, and let me share that so you guys can see it. So Extra Space, past 6 months are down 2.7%. Public Storage, past 6 months is pretty much almost exactly flat. Had a bit of a rough time the past 5 days, down 4% to make them flat. So they're starting to see some opportunities there. But I'm someone that's gonna stick with those 2 that CubeSmart and Public Storage for me. All right, what else we got here before we move on? Cruising through these. All right, let me jump in here now so that you guys can see our next one. So although the top says bank earnings, I still wanted to touch on Morgan Stanley, which just knocked it out of the park yesterday. In terms of share price, I should say. EPS came in at $1.24. They beat by 9 cents. Revenues came in at $13.46 billion, which was a beat by 380 million there. So but the stock, though, that's what I really want to show you guys right now. Let's take a look at Morgan Stanley yesterday, and it was more about the CEO did a good job on highlighting, have we bottomed and whatnot. So they touched on some great things there. But if we look at the 5-day here, which is pretty much made up of yesterday, you could see that Morgan Stanley is up 8.6% in the past 5 days. Again, most of it is started here on 18th into today. It's continued to climb higher, actually, the past few days as well. So Morgan Stanley was a very cheap one there, but now they bottomed out, and the CEO did a great job on CNBC the other day of highlighting and painting a pretty picture for investors to kind of get excited about their moving forward. So in the comment section, let me know, do you guys own any bank stocks? We just went through JP Morgan. We went through Wells Fargo. We saw Bank of America. There's some regionals that have already published their earnings as well. But those are really the big 3, I like to say. There's really a big 4. Citigroup I don't look at all that closely. So I really focus on JP Morgan, Wells Fargo, Bank of America. I own Bank of America, for those of you that follow along on the Dividend Investor's Edge and see my portfolio. If you are a premium subscriber, I appreciate it. We do a lot of great work there in terms of the deep dives, monthly dividend portfolios, and some great stuff coming out real soon as well. So let me know in the comment section, do you own any bank stocks? Let's see. Glad I made the live chat, but need to sign off here. Love it. All right, we'll see you later. Thanks for stopping by today. I know you're in the UK, so it's a little bit later over there. JC added 100 shares of SCHD and picked up 100 shares of DGRO. I like it there. Great timing on SCHD. It's been that technology sector heavy run so far in the stock market. So just picking your spots with SCHD, which is very diversified. I think technology might be the fifth largest exposure in terms of sector. So as more of the sector and more of the market catches up with technology, and maybe technology takes a bit of a breather, SCHD is going to perform. When you have broad-based rallies, SCHD is going to perform. When you have one-sided technology rallies, SCHD is going to underperform. So I'm going to bank on more broad-based rallies moving forward, and just understand that I'll have technology exposure elsewhere. So good, nice ads there. Jordan had a question. Do you know the Blue Owl Cap Corp, ORDC? Just got some shares. Not really familiar with that one, Jordan. So that's one I'll have to pass on and take a look at to see what that one's all about. PayPal is one that has, been a volatile one. I owned shares, when kind of everyone did during that the pandemic boom, but then it really went boom to the downside. So the problem with PayPal I see is they've had their reach now where they're anytime you want to go buy something, whether it's a hat at a hat store online or any other, think of any online. I just happened to buy a hat recently and saw the PayPal one on there. But the thing is there's a lot more options that are popping up as well. There's Shopify has their pay app. Apple Pay makes it a lot easier. When I see PayPal and Apple Pay, I'm just going to easily use Apple. I'll just double click there. I don't have to worry about logging in or doing any of that stuff. There's Amazon Pay as well, which is pretty simple. There's just too many more competition there. And when I see the competition there, I usually go elsewhere. I don't go to PayPal. PayPal is not going to be my first one I'm going to. I'm likely going to Apple Pay or Amazon Pay first. I don't do any of the Shopify Pay, but that's my problem with PayPal and their growth trajectory. How are they going to differentiate themselves, especially when so many people buy things on the mobile device, and most people buy that the mobile device is an Apple device. I know there's a lot of Samsung fans out there, so don't get me in the comments right now, but that's just my 2 cents on PayPal. Microsoft. You can tell what type of day it's been so far. Morgan Stanley, I expected them to beat since they're not a normal bank where you walk in and open an account. Yeah, they have a lot of wealth generating segments. They have obviously investing segments as well. They're not your typical take in deposits and add loans, even though they do that. They have loans as well. I hold Morgan Stanley in my portfolio, the second biggest position in my portfolio. So you were probably, Journeyman was a very happy camper yesterday and throughout this week, finally seeing a lot of that come to fruition and see some big gains there. So 8 to 9% gains in 5 days is pretty solid there. JP Morgan is in currently my biggest position. So you got JP Morgan first and then Morgan Stanley second. So it's been a good week. Amadou's got Citibank, Bank of America, and Key. And Paul has USB. So if you're going to consider regional, it's going to be one of your larger ones. If I ventured into the regional bank sector, that's likely the one I would look at. An old Buffett stock, I should say as well. JC inherited Bank of New York. Yari recently bought Bank of America at $27, and I think what are we at, 31 now? So those are some nice gains there. Well timed. James has US Bank, another US Bank there with Paul. The J, thoughts on H-Man? I own like 60 shares. So let me take a look at that one real quick. Head over to our Seeking Alpha. Oops. I can spell. So we're more in the regional sector here. So you could see the downturn that we saw in that mini banking crisis is what I like to call it here in the March timeframe. And still, even to where they fell on that, we'll call it that first day, even though, it was the first week per se, they just started passing through those. So there's some regionals, higher quality regionals that are starting to look enticing. You just have to have a little bit more of the stomach and allow things to play out, because at the same time, even though, even though we're starting to see a lot of these regional banks start to be able to let's call it weather the storm, and maybe it's not an issue, a broad issue like we saw with the ones that went under. If we do, in fact, go into a recession, the financial sector is going to be impacted, obviously. And the regionals just isn't a space that I necessarily want to be, knowing that is on the horizon. So if I do want to have financial exposure, it's likely going to be at the big banks, which is why I have Bank of America there. So good question. But it's long, like I said, if we don't go into recession, things really improve. You're getting a quality regional bank at a quality price, so that could pay off big time there as well. Excuse me. Paul also owns TRST. So these are some financial exposure here. Kath has some big banks and JP Morgan, Bank of America, and a little bit of US Bank. Mohammed has Bank of America, BNS in my Canadian bank holding for Jim. Bank of America is my third largest holding for Jay. And then there is Doug. Doug, we just got off a call with Doug today from Australia. I appreciate that. Always a pleasure, and it was great to meet you, Doug, there. So thanks for hopping on. Chris, hello from New York. Great to have you there. Earnings tomorrow there from Jay. So Jordan says, I use the platform Fundrise for REITs. Have you heard of that? If so, what do you think of Fundrise? So when it comes to real estate, there's a number of different ways that you can invest in real estate. Obviously, you can invest outright. You can just go out and buy a property just like you would a single family home. You can get into a partnership with someone and bring money together and buy a single family home or a building, an office building or something like that. Probably don't want to get into office right now. But other ways you can do it is through crowdsourcing. One of those is, through Fundrise. And what Fundrise does, they pull a bunch of money together, they buy properties, and then they they pay dividends on the rents that they're earning. They also do loans as well. So it's a little bit more complex instead of just buying buildings. So they do things like that. And it's a way just to earn dividends, but they also take a little bit of a higher fee. So it's a very hands-off type of investing for real estate exposure. But then another way to do it is through REITs. I prefer the REIT route. For me, I'm heavily involved in REITs. I write about REITs on Seeking Alpha on almost a daily basis for under my public name on Seeking Alpha, as well as a marketplace sector under one of the largest REIT sector or REIT marketplaces on Seeking Alpha. So really just very involved in what's going on in that REIT sector. It's one reason I have 15 to 20% exposure to that sector, just well versed on what's going on there. So for me personally, I would prefer the REIT route. And then I would probably, obviously do the physical one as well. It's just a little bit more hands-on from that standpoint. But good question there, Jordan. All right. So I think I cut up to a bunch of different questions there. Let me get back to the slides here and we'll keep moving along. So we already went over Morgan Stanley. So now there was one more that I wanted to touch on last week that I was, very pleased with. And for those of you that do follow on the Dividend Investors Edge, you can see the link down below there at the bottom of your screen. You do know that I own United Health, and I have owned United Health now for probably about a month and a half, I think it is. They reported EPS of $6.14, which was a beat by 16 cents. Their revenue came in at $92.9 billion, which was a beat of $1.94 billion. So a very solid beat on both the top and the bottom line. Again, all the ones we've looked at so far have been beating analyst estimates. That's kind of twofold. Analyst estimates have, they were already down because of, so really, what are we beating? Are we beating because we're doing well? Or are we beating because analysts have just really chopped and not expecting much from these companies and they're outperforming, and maybe we just over exaggerated a lot of it because you're seeing beats across the board so far from the ones we looked at. There are companies obviously not beating, which is what we saw from various ones that have really been volatile here in the past week. So one area you want to look at, and was really the area of concern when it came to the United Health, let's take a look at United Health real quick so I can show you guys instead of just blabbing about it. So let's pull up UNH. So UNH saw a sizable drop. It's probably, right here. We went from around 481 and it dropped down to 448, 445. It went to a new 52-week low. And these came on the backs of, I believe it was the CFO that made comments around United Health's costs going up. So the costs compared to the premiums that they're bringing in. And that really spooked shareholders a little bit. That obviously dropped us down to a new 52-week low. But from then, after earnings that we saw just this past week on Friday, the costs weren't all terrible. So let's go back to the slide here and we can talk about what those costs were. So you can see the operating cost ratio, which is the calculation used here in the health insurance sector. Those increased 14.9%. And looking back a year earlier, they were at 14.6%. So yes, costs are going up. But on the flip side, the company increased their full year EPS guidance by 5%. 5% is using the middle of the range. So prior guidance you can see here was 23.45 per share to 23.75. That was really that's where they thought they would fall in here in 2023. The new guidance up to 24.7 to $25 even per share. So a nice little 5% bump up in EPS. That just tells me that the company's looking to be a little bit more efficient. So usually early on, you'll see some wide gaps, and maybe the company, as it gets closer to the end of the year, they shorten that gap a little bit. But no, this company their low end is now higher by $1 almost than their high end prior. So that's a good sign for me. And we've seen the stock up over 5% just in the past 5 days, up 8% over the past month. So a lot of it's been since Friday. So we've seen a good move higher in shares of UNH, and we are back over $500. So that's a good sign there for another stock. So Bank of America has been good for me so far, and now UNH has been good as well. The J, I see that there, Jay. I really appreciate that. It's always fun, to interact with subscribers of the Dividend Investor's Edge and subscribers to my YouTube channel here. That's why, I started doing the Dividend Power Hour, is not just to be able to talk to a camera, but to continue to educate, talk about stocks, talk about the economy, and see what you guys are looking at and what's on your guys' mind. What stocks do you own? What are you guys buying? So it's always fun to interact. So when I see, someone like that really appreciates like that, I truly appreciate it as well. So thank you, the Jay, for that little tip there. So can everyone like the video? At least smash that like button down below. I appreciate that. Chris already did it. Awesome. Thank you. Be grateful to the man. I appreciate it. And there's Jim, who always talks about hitting that smash that like button down below. So I appreciate that, guys. So let's keep rolling here on this edition of the Dividend Power Hour. So the technology sector, we've talked about quite a few times on this show, on the live stream, how it's been it's been one-sided. It has carried. When you look at the S&P 500, you see companies like Apple, Microsoft, Nvidia, Tesla, Google, Amazon, if I hadn't already mentioned that. And a lot of these have had tremendous years and so far, and we're only 6 plus months in. So when you do that, that's great. All of those companies can do that. That is great, but I want to see it broaden out. I don't want it just to be one or two sectors, and that's where I have concerns. So we've kind of compared the equal weighted S&P 500 and really seen the wide gap. It's been the widest we've seen in a number of decades. But over the past week or so, that is starting to come together a little bit, which is good signs. We've been expecting technology to take a bit of a break here. So if we start to see that, I think that's going to be good news for the market. We do want to see a pullback. And the S&P 500 can still be coming down while other stocks are going up, because remember, it's a market cap weighted. So if Apple's and Microsoft's of the world are coming down, most likely the S&P, because they have a large weighting within the S&P 500. So XLK, which we looked at the start, reached a new all-time high on July 18th. So that's just 2 days ago from when we're doing this live stream right now. Today is July 20th. Today's actually my dad's birthday. So happy birthday, Dad, if you are on the live stream today. So XLK reached a new all-time high, but then we saw that pullback in technology today. We saw it technology, we saw it in communication services, and two of the big components that got hit hard in certain sectors, and we'll call these technology stocks. They're not technically XLK, but it kind of dragged a lot of that stuff down with them. So Netflix, on the backs of earnings, was down 8.4%. They missed their Q2 estimates, and they also offered weak guidance. The one thing with Netflix, even though it's not a dividend stock, I just want to touch on these real quick because it relates to the whole technology sector coming down. When you talk about the Magnificent Seven or something, I refer to them all as technology, even though they're technically in different sectors here at Netflix and Tesla. But they've been cracking down on the password sharing, so they've seen a boost in growth in subscribers. Margins improve a little bit there, but the guidance moving forward is a little weak. So maybe it's more of like a one-time event with this password sharing thing yet. I'm not going to ask for you guys to comment to let me know if you guys share passwords for Netflix, because I don't want the Netflix folks watching this. So Tesla was also down 9.74% today due to margin pressures there. They and the competition, more EVs coming out, a lot more companies pushing more EVs. Their fleet is becoming more electrified, we can call it. We've seen prices slashed on many of these Teslas as well. So they've even announced that they'd be closing one of their factories for a little bit of time. Now, they obviously, the way they say it is they're looking for some improvements and some enhancements in that factory. But could it be a lack of demand? You never know there. It's anyone's guess. So something definitely to keep a closer eye on. But the other stock that we want to touch on real quick is Johnson & Johnson, which, again, if you follow me on the Dividend Investor's Edge, you are a subscriber, this is one of my top positions. So it was so good to finally see Johnson & Johnson make a move higher, because we have been waiting and getting very impatient with Johnson & Johnson. Today, let's take a look. Let's head over to the Seeking Alpha here and take a closer look at Johnson & Johnson. So J&J up 6% today. Not too often do you see a Johnson & Johnson move of 6%. So that was probably an ill-timed market down here, or article, I should say, here on Seeking Alpha by this gentleman, Edmund Ingham, who was saying to sell the stock on July 18th, because since then, someone has probably made about 8% so far, because stock was up yesterday as well. So a 6% mover higher on Johnson & Johnson on the back of some solid earnings. Let's take a closer look at those. So EPS, they beat on both the top and bottom line, came in at $2.80 on EPS, beating by 18 cents. Revenue came in at $25.5 billion. In addition, they also increased their full year guidance, not only EPS like we saw with UNH, but also for revenue. So a double upgrade there in terms of revenue and EPS moving higher. You could see the middle of the range was 1065. It is now 1075. And then revenues went from, call it 98 billion, 99 billion to now being 98.8 billion to nearly $100 billion in revenue. So definitely some great news there. But really, I think something that really moved the stock higher recently was the announcement of their plan to divest from Kenvue. So as many of you are probably aware, we cover Johnson & Johnson a lot on this channel. They have for years operated within three segments. You had the consumer health segment, you had the pharmaceutical segment, and then you had the medical device segment, also known as medtech. Pharmaceutical has largely been its fastest growing, its largest segment, but the consumer health one is the one that owns Band-Aid, Tylenol, Motrin, Zyrtec, Zarbee's, and the list goes on. Aveeno, Neutrogena, any of those products are all owned by the consumer health. So this year, Johnson & Johnson spun that sector off into its own public company, allowing the company to focus more on pharmaceutical and medical device, and consumer health to focus more on just that segment as well. So Kenvue went IPO a few months back. Stock, I think they IPO'd around $22. Stock's around $24 now, so it's up about 10%. They recently announced a dividend as well. But Johnson & Johnson still owns roughly 90% of that company. So although they're trading as a separate company, the largest shareholder is still Johnson & Johnson. And on the earnings call, they announced plans to, here in the near future, divest from that. They said they'll probably likely hold on to a decent chunk of it. And so not all 90% is going to be sold. But that, I think a lot of people are trying to get into Johnson & Johnson because we could see a sizable, maybe a special dividend of some sort once they do that. And they have a bunch of cash coming in also. So definitely something exciting there with Johnson & Johnson. So let me run over here back to the comments. I know I've missed a bunch there. So let me, Jordan, Lowe's is on a huge rise. Lowe's has been doing quite well of late as well. My banks are TD, BNS, BAC, and USB. Side Hustle PR. Love to hear your opinions on stock for dividends. Keep it up. Thank you. Thanks for tuning in. It's always enjoyable to talk to you guys. Tech took a turn today. The dividend CPA's got to get back to the books, back to work for me, closing out that quarter end. Keep up the great work, Mark. Thanks for tuning in, my friend. Paul said, Pfizer, BMY are undervalued, solid plays. Definitely agree. Pfizer continues to be, on my watch list there. I feel like I'm overexposed to healthcare right now. That's a good area. I think that is where the tide is kind of hopefully going to turn here for healthcare quite soon. So don't want to overexpose myself. But if there's one stock that I don't own in that sector right now, it would probably be Pfizer that I'm taking the closest look at. I already do own a good portion of Bristol Myers. So, everyone smash that like button. You know it, the J. Let's see what else I'm missing here. Oh, so speaking of that, Chris, right on cue, looks like healthcare is making a run now. Absolutely agree. Paul also has himself some Johnson & Johnson. So Lex brings up another great point here, and I'm actually doing a video that's going to be coming out on Monday discussing this briefly. But are you concerned about their opioid and talc legal problems? So the opioid one is one that kind of goes along with all of the these pharmaceutical type companies, but the talc legal one is the one I'll speak to. So I think there was an $18.8 million, and that's on that slide there. Let me pull that back up there. So you can see J&J was ordered to pay $18.8 million over a baby powder cancer claim. So a lot of the issues with Johnson & Johnson has been around this talc-related issue. And it's a lot of users that are accusing the company, saying they used the baby powder that caused ovarian cancer. Well, this one particular one here in California that you can see, the $18.8 million, wasn't related to ovarian cancer. It was actually something different. And the company believes it has a strong case. And a lot of the data and facts that they said they've come out after this ruling, so they weren't allowed to share, which would give them they feel a strong case to overturn this and clear them of any wrongdoing. So they're definitely saying they're appealing it. They were very opinionated on this one. So again, it's a one side of their bias at the same time, but also I think it's interesting and curious as to why some of these facts weren't able to be placed in during this particular claim or why the jury wasn't made aware of these things. I have no idea. I'm not in legal. I do enjoy legal shows. So if you ever do have good legal shows, let me know in the comment section, because I enjoy watching those. But I think it's something that's been holding back the stock. And obviously new investors probably want to see some sort of clarity. It's a very similar situation with 3M. They have this dark cloud over them with a lot of these legal issues. But I believe, between 3M and Johnson & Johnson, I believe Johnson & Johnson is going to be able to weather the storm a little bit more. There's already talks of a potential settlement with the ovarian cancer group. That lawsuit has a lot of people involved there. So I would personally love to see clarity on this, obviously. But it doesn't seem like it's overly concerning compared to someone like 3M, which that one can have a major impact on that business moving forward. So that's kind of my take on Johnson & Johnson. What else do you guys have here? Paul, is J&J shareholders can convert to Kenvue shares if they like. James, yes, you're welcome. Chat, just catching up. Mark, quit tanning with sunglasses. James, I feel like I just have that skin tone, and part of it is these lights that are all hot on me. It's I feel like I have the AC on. I feel like I sunburn at nighttime. The moon probably burns my skin. So this is just, I haven't even been in the sun all that much. Matthew Cruz from Irvine, you are the man. Thank you, my friend there. That's a local one there. I'm here in Southern California as well. Y'all need to look at LMAT and FLO. All right, so let me go back here. Let's keep rolling here and see. So that's kind of the Johnson & Johnson story. So really, really quickly, I want to show you guys my top holdings in my portfolio. So top holdings, if you were to look at my portfolio, and if you're a subscriber to the Dividend Investor's Edge, and if you're not, definitely subscribe today. You see the link down there at the bottom of your screen. And by being a premium subscriber, not only do you get the free weekly market updates, but as a premium, you also get my dividend portfolio updates. I do a full write-up showing you my entire portfolio, telling you what did I buy, what did I sell, why did I buy it, why did I sell it, what are top 3 stocks on my watch list right now, as well as, we have valuation dashboards, we have stock deep dives. We do 2 stock deep dives per month. So those are, definitely in depth. I spend hours on putting those together and doing the research. It shows you a bunch of different valuation metrics just to help investors determine whether a stock is a good buy or not. It's got, everything from price targets to current values, all the different metrics you could think of. So definitely, give it a try and come join us over there. So top 5 holdings for me, I always talk about building a firm foundation. The way I do that is through those top 2 index funds, the Vanguard S&P 500 Index Fund, VFIAX, and then that is followed up with VFDADX, which that I love, Dividend Growth. So that is a Vanguard Dividend Appreciation Index Fund. Those ones is just my set it and forget it. Turn the drip on and let those continue to accumulate shares. Following that, we have SCHD, which has climbed the ways here for me up to a top 5 position over the past few months. That's the Schwab US Dividend Equity ETF. Obviously, a very well-diversified ETF. They have a top 5. I think it's number 5 for exposure to technology. One reason why that one has underperformed. But I think, once we broaden out, like I keep saying, once this rally starts to broaden out and tech maybe takes a bit of a breather and the other sectors start to catch up, that's when SCHD starts to turn the corner a little bit. So hoping for a good second half from SCHD. Definitely, they have healthcare exposure there. But, if we look at SCHD over the past 5 days, they're up 2.5% and up 3% over the past month. So hopefully there's a turning of the tide there for them. Johnson & Johnson, we just touched on that one. They had a big move today, so we'll see how that one follows up their earnings tomorrow. And then Lockheed Martin rounds out my top 5. Now, Lockheed had we didn't really touch on their earnings at all, but they had a little bit of a rougher week. Rougher, I don't know if that's politically or vocabulary is correct there, but we'll go with rougher. And over the past 5 days, the stock is down 2.5% there. So they're starting to look a little bit more intriguing. Again, now it's a top 5 position for me. So do I want to necessarily add to my Lockheed position? But this is just one that, these defense contractors have huge backlogs. And you see more and more of these countries that are looking to bolster their military. Well, you need the likes of Lockheed's and the Raytheons and the General Dynamics, and the list goes on, Northrop Grumman and all that stuff. So Lockheed's one of my favorites in that whole entire sector. I also own a little bit of Raytheon as well, but definitely Lockheed's the largest. It's one that's always going to be necessary, just like Band-Aids are always necessary, Tylenol, defense, and it's always technology and upgrades that are going on there. So you can't really use a lot of the old stuff. And it's just a what do I want to call it? A safety one for me, one that I can fall back on, knowing that, it'll be a little cyclical at times, but just seeing the backlog that this company has, I have, high hopes for Lockheed moving forward. So let me know, what are your top 3 holdings? We're going to wrap up the Dividend Power Hour here, but let me know quickly before we go, if you have any more questions. Let me know what your top 3 holdings are within your dividend portfolio. So in the meantime, thank you guys for joining. This is one of our largest in terms of people that watched it live. We had well over 150 people in this live stream at one point when I looked up there. So that's been great to interact. I've seen a lot of new folks in the comment section that I haven't interacted with in the past, but a lot of the familiar faces as well. So I thank you guys for coming back, and it's always fun to kind of mingle with you and talk stocks and the economy. So let me know quickly before we head out onto our extended weekend, since we do these shows on Thursday. Let me know if you have any more questions and what your top 3 holdings are. So Danny is in Minnesota. So thank you, Danny. You made it through the entire show there. So thank you for joining. Looks like slow future growth to me. Slow future growth is okay at times. Again, it's all about safety and taking risks, because if we look at a lot of these high growth stocks and folks that a lot of folks that are talking now, 2022 was probably a really rough year, and especially a lot of people that sold out on the lows of the 2020 crash. So it's just really looking, especially at the top. My top 10 positions are all about stability. Once I get beyond that, that's when I can start taking more risks. Obviously, a lot of my option plays aren't discussed and shown on my dividend portfolio, but those that's part of my risk portfolio, where I add 5 to 10% of my portfolios for risk assets. I also have growth assets, which aren't shown on my portfolio because this is a dividend portfolio, but I have likes of Google and Amazon, AMD, Tesla, and stuff like that. So, it's always fun to kind of see what everyone has out there. Jim has no ETS for me. Johnson & Johnson number 6, Lockheed Martin number 8, top 10, but not in my top 5. Top 3 are Kevin has 32 positions, average around 325, 350. Excuse me. Top positions are CAH, GILD, Gilead, and SWK. I like that one. That's one I've been looking at. Chris, top 3 are TQQQ, Microsoft, and YINN. I have a lot of tech, but growing my dividends. That's solid. The tech has had a great run. If you have high tech right now, your portfolio has been sitting pretty. But now you can look and say, hey, are these areas where maybe I can trim a little bit? I don't want to get rid of the technology. I never want to get rid of my technology exposure, but there's always areas to trim to add to areas that may have lower valuations look like great valuations and can be great long-term plays that meet your strategy and your game plan. Journeyman's top, we saw earlier, his top two were JP Morgan and Morgan Stanley, and then Apple is the third one there. Jordan's top is McDonald's, SCHD, and Johnson & Johnson there, 3 dividend-paying stocks. Paul, I think you meant VDADX. I did. Was there a... Yes, you are correct there, Paul. Thank you. VDADX, which is a dividend appreciation index fund from Vanguard. Jim, top 5 non-ETF holdings are, as for me, Realty Income, Coca-Cola, AbbVie, Procter & Gamble, and PepsiCo. Jordan, thanks for all your great info, Mark. Thank you for tuning in, Jordan. Mike D, SCHD, IIPR, and VOO. Chris, thanks, Mark. Great to hear you on site. Hear you on site on the market for sure. Doug Devine, my top 3 are Gold ETF and ASX ETF, Apple and SCHD. Solid there. JC, Apple, PEG, SCHD. Thanks from Corona, Mark. Again, Paul, you're not too far there. I'm in Southern California as well, so Corona is just down that 91 freeway. Even though we may only be 30 to 45 minutes away, it probably takes me more like an hour and a half to get to Corona. With that 91 is a rough one, as you are probably well aware of there, Paul. I will be on that 91 tonight, actually. Jim says the top 10 swan stocks sleep well at night. That's always the key with your portfolio, especially the top of your portfolio. You want to be able to sleep well at night, knowing that they're continuing to generate cash flow, free cash flow in particular, and things you don't have to worry about, a big 10% drop tomorrow, 15% drop tomorrow. That's always the key, is you want to have that firm foundation. We got Coca-Cola, Pfizer, and Medtronic. Here we got J&J, O, and Microsoft, and we'll do one more. Insight on the market, no problem. iPhone autocorrect. Watching it on the iPhone, I understand how that can be difficult. So that's going to wrap up our show today, folks. It's been an awesome show. Thank you guys all for tuning in. Thank you for the great questions. We continue to go through a market that's just, are we starting to see a top in technology? That'll be something that I continue to focus on, as well as all the earnings reports. This is a heavy earnings season. So, check and see what individual stocks do you own? When do they report earnings? Things can get a little bit volatile. So if there's positions that you like, maybe wait till after earnings, see if you get a drop. Or if it pops, that's a great thing. If it drops, it allows you to buy more if you like the stock. So definitely thank you guys for tuning in. Thank you guys for the support. If you haven't done so yet, hit that like button down below, and we will see you in Monday's video that comes out. And I think you're really going to enjoy it. I've had a great time putting that together. I'm continuing to edit right now, but it's going to come out with my my top 5 forever dividend stocks. So thanks again for tuning in, and we'll see you next time. Take care.